strategy. What does that really mean? We've got access to the full suite of views and tools. So we're global, unconstrained, unbenchmarked. But what we do is through the lens of capital preservation. So we're looking always, first and foremost, to manage and protect investors against risk, and then secondly, to deliver opportunities, and doing that through all market conditions. So the role that we can play in a portfolio, therefore, is to deliver a very uncorrelated and differentiated return stream for investors. Over our 30-year history, and this is the same strategy we've been running over those 3 decades, we've delivered a net annualised return of around 8%, which is ahead of UK equity markets, but perhaps more importantly, that pattern of returns has been very, very different. So in all 4 of the key market inflection points over those 30 years, we've protected and grown our investors' capital. Now, the key to doing that consistently has been to have a portfolio that is flexible, because the nature of each of those crises has been very, very different. And why now and why diversifiers, I think the case has never been more compelling, because the world around us is getting a lot more volatile, and the investment environment that we're currently living in is changing. There's greater inflation volatility, geopolitical volatility, fiscal deficits are a challenge. And why we care about that so much is the impact that it has on asset class correlations. I think the biggest risk that investors need to think about is that for a really long time, multiple decades, bonds and equities have had a very helpful negative correlation. So through periods of market stress, bonds have offset. In today's world, this more volatile, challenging environment that we've described, I think bonds as a safe haven are far less reliable. And that relates back to the piece around inflation and inflation volatility. What that means for investors is they are going to have to consider a wider toolkit and a more diverse range of assets. The problem is that it's not just bonds failing to protect like we saw in 2022, but in April last year through Liberation Day, we had bonds and equities falling together, but so did the dollar. It failed to protect investors. So you've now got 2 safe havens that are far less reliable than they were. The big question for investors is that a moment in time, or is that something that's likely to persist? Our perspective and our outlook is very much that this is likely to be a continued challenge, that safe havens are far less reliable, and investors are going to have to look more broadly for that protection and diversification. So the focus of our positioning is looking for those differentiated assets, both on the protection but also the growth side of the portfolio. So if safe havens are less reliable, bonds and the dollar won't do the role that they have done in previous decades, we've built out a derivative toolkit within our portfolio, which is challenging. They're more complex assets, but we think necessary in this new environment. So opportunities that we're seeing there are a portfolio hedge in the form of credit spread protection. So this is an asset class that is going to benefit if some of the risks that investors are worried about today, whether that's AI disruption or private credit, persist. I think it's really interesting to note that spreads have started to widen over recent weeks and days as those fears around private credit have continued. So it's toolkits like that. The other thing is using bonds in perhaps a different way to they have been over recent decades. So traditionally as sort of a buy and hold asset in portfolios, we think they need to be used much more tactically, and bonds to be thought of more like a risk asset. So there will absolutely be moments when bonds are going to be a helpful investment for portfolios, but just in a very different way. So we're using bonds much more tactically. We've got the derivative toolkit. I think commodities and precious metals are going to be key. So we've got about 4% of the portfolio across oil and oil-related equities, about 4% in gold mining equities. They were fantastic provider of returns for us last year. They outperformed the metal very, very significantly. And I think all of the structural reasons that gold has performed well over the last couple of years will remain. So commodities and precious metals, and then finally on the growth side of things. So as discussed around kind of the US and some changing forces there, US equities having been sort of the only game in town for 10, 15 years, we think that's going to start to broaden, and the risk assets we've got exposure to in the portfolio are broadly pointing away from the US, rest of the world. We think Japan is interesting, or kind of restructuring and governance story. We've got a small amount in China equities that have been a meaningful contributor to returns over the last 18 months or so. And actually, perhaps controversially, we quite like the UK, and that's one of our biggest geographic exposures, where there's a lot of concern around public sector finances, but actually private sector balance sheets look a lot more healthy.